Thank you so much, Mr. Chhaochharia, for joining us on this show today. The first day of the new year, if you follow that calendar. How are you looking at the markets right now? What is the overall investment scenario looking like?
So markets have two big drivers right now for the near term and possibly for the next 6 months. On one side, we have a globally benign liquidity and risk-taking environment, which is helping markets, including India, where investors are looking for yield, looking for growth, and India clearly stands out. And on the second hand, we have local fundamentals where while the macro is very robust, very solid, and the long-term outlook remains very positive, the near-term growth pickup continues to disappoint. And our view is that even for second half, from October to March for fiscal year 17, the earnings growth and the broader GDP growth expectations, that's likely to underwhelm versus market expectations. So that is the two conflicting signals for the market. On one hand, we have supporting technicals, but fundamentals are not going to be supportive near term in terms of earnings growth.
Okay, let me take the second one up first. You don't see earnings growth in any segment of the market, or you think that there are some which will outperform?
No, earnings growth is not no earnings growth as such. Earnings growth is likely to be tepid and much behind what the street or markets are expecting or factoring in. And even over the last couple of years, it's not that segments or sectors haven't delivered earnings growth. We have seen select pockets in non-bank financials, even in the consumption space, etc., which have delivered earnings growth. And some segments and stocks will definitely deliver earnings growth. I'm talking about the aggregate market level. When I look at, for example, the street's second half implied growth earnings growth, it suggests 25% earnings growth in second half for the market, which in our view is very unlikely.
So when, in your view, when people say that the Nifty is trading at slightly higher than fair value 1 year forward, you actually believe that number, that multiple itself is in a sense optimistic, because earnings growth has been projected to be much higher than what you think it's likely to be.
Absolutely. So the markets are trading rich from a near-term perspective. Definitely, the risk reward is not attractive at these levels.
Okay, let me break that up into companies which, let's say, cyclicals, financials, consumption-oriented, and capital goods. If you had to break these up and take these separately, where do you think we'll see the maximum disappointment? Where do you think that the numbers will more or less match what the markets are expecting?
So if you're looking at an aggregate for all these four categories, I think you will see disappointment across four. Degrees will differ. It's actually a lot more difference at the stock level than the sector level. But all these four sectors, in our view, will miss the estimates out there for second half.
All right. So if I look at consumption, let me take that specifically. We have seen consumer durables. We've seen FMCG. We are seeing a sense that there is going to be a slowdown or at least no recovery in the FMCG space. Do you see that is an overall story for FMCG or consumption, or do you think pockets within consumption where the future looks good?
So the long-term future looks good for broader consumption in India, definitely. But for the second half specifically, the pockets where we do see some sense of hope or earnings estimates being met is specifically in the paint segment, and while the broader consumption segment still looks elusive.
Okay, let me take up consumer durables, for instance. Within that consumer discretionary, consumer durables, there's also the auto pack. Now, we're seeing the October numbers which are coming out one by one, and we've seen good performance from Eicher Motors, for instance, but a relatively disappointing performance from Maruti, which is in October, it's actually dropped a little bit, although domestic sales have gone up marginally. But if you look at the overall sales number, October sales number, it has actually dropped. It's flattish. It's dropped about 0.3%. Do you think that the auto story is more or less done, and even the growth that we've seen this year is largely driven by discounts?
So autos is one of the good long-term stories in India, and specifically in passenger cars, our analysis and even a proper survey suggests that the pent-up demand remains huge. But that's a 3-year story. The 6-month story is similar for autos. What we said about the broader macro as well as broader consumption, that while the numbers will be positive in absolute terms, it will be behind what the street is looking at. And within the broader autos, two-wheelers is again another sector where there's been a lot of hopes around monsoons, etc., which I think will again disappoint versus expectations, because the impact of monsoons on rural economy is not as much as markets think it to be.
In fact, we've just got some data from Telangana, for instance, and I understand that the number of suicides there, farmer suicides, has actually gone up because a lot of crop destruction has taken place because of unseasonal rain, and the fact that the rain has been more, farmers didn't expect. They didn't actually protect their crop in that way. But I'm just, let's just take it a little bit more macro and not just look at the markets per se. One of the reasons why people have been expecting a recovery is because there has been a consumption story that we've been talking about. The consumption is recovering. Now it's starting to stall a bit. There is no clear signal that consumption is going to grow at the rate we've seen in the last 1 year.
So consumption, there is two elements. One is a secular growth in consumption, which has been holding on reasonably well even over last three-year period, not just over last 1 year. But the acceleration in the consumption growth rates, which markets have been expecting, that is yet to happen. In our top-down macro, we will not happen in a hurry. Because we're not yet seeing job creation, and the real income increase is also not happening. So while inflation has come down, so has nominal wage growth, and therefore at a real income level we are not seeing any boost to the broader population. So if you combine lack of job growth and no real income boost, I fail to see where the big boost for consumption versus the trend growth which we are already seeing will come from.
I just want to pick your brains a little bit more there. If one looks at the fact that, there was an expectation of rural incomes going up, partly because of the monsoon, but also because of government spending in Narega, government spending in roads. 85% of what the government has in its hand to spend has apparently been met already in the first half. And we've not really seen that boost come through. So the second half could actually turn out to be worse.
It's possible that the second half spending, but if we look at the broader revenue projection and the fiscal position, it's too premature to make a judgment call whether the second half will see a spending cut per se by the government. It's still early days. But specifically around the role of government spending, I think the role of government spending in the broader capex cycle of public investment is fairly limited. So when you talk about more spending, it would look at the broader macro context rather than just looking at one micro segment where the spending is increasing by the government. And again, going back to the monsoon part, the role in rural income is fairly limited.
No, the reason I was talking about government spending is essentially in terms of giving money into the hands of people to spend, because we have seen very slow job growth for instance, if one looks at the construction sector, the constraints on black money, the collapse in the real estate space, more or less has put a top or a lid on construction employment, which was a great driver. Textile exports have not really picked up so dramatically that they're going to employ more people. We've actually got reports of how Narega investment, Narega spending has been curtailed by off-the-book orders from the government that don't spend. We haven't seen the kind of layout that the government was going to do in rural India as was expected. So I'm saying, where will that money come from ultimately? When you say the 3-year story, where is the money going to come from?
So exactly the point. So the big picture, macro, simple point is that the government is still in a fiscal consolidation mode. So while it might increase spending on roads or increase spending a little bit on irrigation, but at the broader macro impulse perspective, you're still in a fiscal consolidation mode. So till we look at fiscal consolidation stopping, which as per the current FRBM roadmap FY18 will be the last year of fiscal consolidation and the government can stabilize unless they relax the limits. That itself creates room for them from a 3-year perspective. Secondly, if you look at even the monetary side, we've had a fairly tight monetary policy environment for the last 3 years. That's also getting neutral, at least to a neutral stance as we speak. And on all the other big drags on the macro from exports, from the banking system, that should also gradually stabilize or if not recover. So we'll see some kind of recovery from here, from the next 3-year period definitely versus the current trend growth. But for a sharper uptick, we need a more bigger change in policy stance or global economy to pick up more sharply.
Well, let's say if I were someone who wanted to be an entrepreneur and I wanted to set up a business, which part of the industry, services looks like a space where I could actually get good returns, have a steady demand?
So over a 3 to 5 year period, most of the sectors, as you mentioned, services, consumption, financial, they all should offer good returns, both in absolute terms versus the cost of capital and definitely versus what you can get in the rest of the world.
No, but again, my question to you is that, let's say I have given up a job and I want to set up a business, right? I don't have any space where it looks like there's going to be a steady demand, and I'm assuming that effective demand would depend on people earning more, having jobs, more jobs. Where would I actually start going and go in and say, okay, this is the space where I can set up a business. This is what I would like to. Let's say, restaurants not doing well, steel not doing well, textiles not dramatically doing well. So what looks like a space where I can go in and maybe set up a business?
As I said, except commodities and global linked sector, most of the local linked sector should do well over a 3 to 5 year period, except obviously segments where there are segment specific issues like competition or mispricing or irrational pricing behavior in terms of competition, for example in restaurants possibly. But in general, the current growth rate also is reasonably good, and if it starts moving up over a 3 year period, it should be good. The problem I think is, as is with the market, if you're looking at growth or return numbers to be very high, for example, if you're looking at 25% returns, then that's where the problem is. We have to reset our growth and return expectations. One of the things which we keep saying, and we've written in our research also, is if we are anchoring our growth expectations for India GDP and earnings to what we saw in 9, 10, 11 or what we saw in 05, 06, 07, then that's where the problem is, because those were not periods of trend growth. Those were periods of significantly above trend growth rates. To achieve that, you need many more things to fall in place. So it's more of issue of expectations and applies to the business people as well as for the markets.
All right, very interesting. Okay, let me go back to individual sectors. I was reading a global UBS report with which there is a bit of optimism about China. Now, do you agree with that kind of a stand when you look at India? Do you think that cyclicals are going to revive in India as well because of the demand growth in China?
So the optimism around China is again versus expectations. We expect there's no hard landing there, and what we expect is the policy support which China has seen over the last few months can lead to even more surprises on the positive side over the next 6 to 12 months. And that should bode well for, in general, risk assets globally. But at the margin, in a relative sense, is not necessarily great for India, because India gets hurt by any rising commodity prices or oil prices beyond a point.
But something like steel, for instance, I mean, we've had to protect the industry from China dumping steel. But if there is a recovery and prices improve, then I'm assuming that steel would gain.
Theoretically, yes, but again, we have to see whether the production remains in place or not, and therefore whether that higher steel prices comes through in the form of higher margins for these companies or not. And again, in our thesis, most of these companies, so we had a positive bias on the steel names late last year and early this year, but we just turned kind of neutral on that space now, because the stocks and valuations are already implying much higher levels of profitability and that to sustain versus what we think is reasonable.
How sensitive is crude to Chinese growth? Is there any correlation that you worked out that this much growth in China tends to lead to this much increase in crude prices?
Crude has obviously various drivers, not just demand supply. There are obviously geopolitical issues also. But Chinese demand does play a role at the margin for crude. Our house view is definitely for crude to go up beyond 60 next year. Whether it goes there sharply or gradually and how much higher is what will drive impact on India and Indian markets.
So that has quite a few implications for India, right? Because it has an implication on oil marketing companies which have been the darling. So let me start off with that. OMCs, what is your view on that in India?
So we don't have coverage on oil and gas companies right now because of analyst turnover. So we can't really comment on that sector right now.
All right. Okay, but it has an implication on the fiscal deficit as well because we've gained.
Definitely.
So is that something that you're working into your model?
So what we have published earlier a few months back was that till $60, the impact on Indian macro is not meaningful or it does not really matter. If oil shoots up in a hurry beyond $60, then it starts hurting India's macro, fiscal, current account, etc.
In terms of the something closer, in a time sense, that's the U.S. elections. If there is what some are calling the black swan event of Trump winning the elections, how important is that for the global economy?
Tough to say because a lot of the, as we see in elections around the world, a lot of it is pre-election posturing, rhetoric, etc. So I don't think the market just reacts on just one election outcome per se, but more on what the policies are laid out by whoever wins the election.
How would the markets react if Trump wins? Would you see a bit of a panic sell-off in the U.S. markets?
Again, we don't have any published view there, but again, in my view, beyond 1 2 day impact, I don't think any outcome will be just based on one election outcome. What the winner announces in terms of policy guidelines or policy views post-winning, that will be more relevant rather than just the outcome of the event per se.
Globally, do you see that governments are going to be more protectionist? Governments are going to spend more in terms of give more fiscal incentives?
So protectionist, again, there are various drivers behind that. So we don't, our base case is no, that this protectionism is not really a long-term trend. But in the near term, difficult to say. In terms of fiscal incentives, again, most Western world countries do have limited fiscal space to begin with. Now, whether they go down the path of what Mr. Bernanke has advocated in terms of kind of a fiscal QE, again, we haven't seen anyone adopting it yet, because that will again be kind of a next step in the uncharted territory which we are looking at right now. So again, difficult to build that into your base case as we speak.
But Trump victory or Trump coming very close to Hillary Clinton would make many politicians across the world take it seriously, and they'll probably think about dealing with people differently, right? So that's why I'm saying that, do you see that governments looking at the way they looked at the economy differently from the last 20 odd years?
It's possible, but again, too speculative right now. It goes beyond my capability to comment on that.
All right, fair enough. Okay, let me come back to India. What are you looking at in terms of possible bets, or are you just saying that advising people to stay on cash at the moment?
So at a top-down level, definitely risk reward is unattractive for the next 6 months for the market at current levels. But again, most investors are benchmark investors. They can't really stay in cash. So keeping that in mind, what we are telling investors is be much more stock specific than they have been historically, because within sectors also we are seeing a lot of dispersion. Beyond that, what we're recommending right now is stay selectively overweight financials, non-bank financials, and some private banks also. Stay underweight capital goods, infrastructure, IT services. Stay overweight pharmaceuticals, and then it becomes much more stock specific in terms of the other sectors.
And do your disclosure norms allow you to speak about stocks at all?
No, we can't. Sorry for that.
All right, Gautam Chhaochharia, thank you so much. Pleasure having you on our show. Thanks a lot.
Thank you.